Okay, welcome back to our discussion of perfect competition. What we want to look at now is when would a firm choose to stay open and when would they choose to shut down? And specifically, as you could see the question, how do firms deal with short-run losses? So we know that the firm is forced to take whatever price it can take. What happens if there's a price drop, right? And this could easily happen. You could see the demand in the market drop dramatically. And if the demand in the whole market drops, that means the equilibrium price for the market drops, which means each firm would be having to accept a lower price. Or perhaps a lot more firms enter into the market for whatever reason. Right? There is easy entry and exit, so if more firms enter into the market, greater supply, price drops. Well, the firm would be forced to take a new lower price. So in the short run, should the firm shut down if it's going to operate at a loss? Well, I haven't given you enough information yet to answer that. So right now it's just, it depends. Maybe, maybe not. What we're going to do now is let's look at when they should shut down in the short run and when they should stay open in the short run, even if they're operating at a loss, right? The idea here is loss minimization. If the price the firm can get in the short term is above the average variable cost, the firm should stay open, right? And we have here the average total cost, right? In order for the firm to make money, they need a price that's above the average total cost, right? You know, the price is the average revenue, the average cost is average total cost. So the price has to be above the average revenue. And in fact, you know, price is going to equal marginal cost. So this is going to end up being our supply curve, as we see soon. The firm operates at a loss at any price below average total cost, but it should still stay open if it's above the average variable cost. The time the firm should shut down is if the price is below the average variable cost. But I want to go back to the idea of when should the firm stay open and why. So the firm should stay open if the price is above the average variable cost, even if they're operating at a loss, so in this area here. So the question you should be asking, of course, is why, right? They're losing money. Why do they stay open in the short run? Well, recall in the short run, there are costs that the firm has to incur regardless of how much it produces. And in fact, even if they shut down, they incur these costs, right? Building costs, like for leasing a building, you may enter into a year-long lease. You are stuck paying whatever money you agreed to pay for that entire year, even if you shut down. So if the price is above the average variable cost, what it's telling us is you're losing less money by staying open than you would if you shut down. So let's imagine Domino's Pizza, for example. Maybe they pay $1,000 a month for a small building in their lease. And if they shut down, that's what they'd owe. They'd owe $1,000 a month. If they stay open, right, when should they stay open? Well, they should stay open anytime they will stay open and lose less than $1,000 a month, right? And we are factoring in our opportunity costs here. So this is not the idea of lost wages for the owner keeping it open. That's factored in here. If the firm can stay open and lose $100 a month, in the short term, they should still stay open because that's a lot better than losing $1,000 a month. If, on the other hand, they're going to lose, say, $1,100, $1,200, that would be represented by this portion of the graph. Then each pizza isn't even covering the variable cost. Then they should shut down. Well, all this goes together to show us what the supply curve is then for the perfectly competitive firm. All at any price below the minimum average variable cost, the firm's going to produce nothing. But above the minimum average variable cost, the marginal cost curve is the supply curve for our perfectly competitive firm. So the firm's short-run supply curve is the portion of the marginal cost curve that's above average variable cost. This part right here. So the firm is, if the marginal revenue, the price is greater than the average variable cost, the firm should continue to operate even though they're operating at a loss. But if it's less than average variable cost, the firm should shut down. In the long run, it's much simpler. If you make money or are breaking even, you stay open. If you're losing money, you shut down. So if price is less than average total cost, you shut down in the long run. If it's greater than or equal to average total cost, you stay open. So for the long run, it's looking, instead of average variable cost, it's looking at the total cost. The reason for that, in the long term, you can get out of your fixed costs. So if you're Domino's Pizza, in the long term, you can get out of your lease. And indeed, that's what you'd want to do. You'd want to get out of your lease because you're losing money. You just want to get out of it and shut down. So we discussed the marginal cost curve above the average variable cost is our supply curve. So it is this area here, right? This is a graph that has our marginal cost curve, our average variable cost, our average total cost. 0 from here. The supply curve for the firm, marginal cost curve above average variable cost. In the industry, the supply curve is simply the sum of all the short-run supply curves for each firm. At any given price, you'll have a number of firms. Each is willing to supply some amount of the product. The industry, it's just simply the sum of all of them. Well, in the long run, perfect competition has a pretty unique aspect here, an interesting equilibrium. Right, in the long run, firms can get into and out of all of their fixed costs, so no firm has any advantage by having, as we say, the correct amount of fixed input. All firms can adjust perfectly. So what happens if more firms enter the market? Well, profits will drop for every existing firm. Right? Think about that for a moment. More firms enter the market. The supply curve for the entire market will decrease. Or I'm sorry, will not decrease. The supply curve for the entire market will increase. It will shift to the right, which pushes the price that will decrease. The price will drop. If firms exit the market, the price will increase for every firm remaining in the market. Well, this has a pretty huge implication because recall that our profits from our section on marginal analysis and output price and profit, 0 profits are normal profits, right? That's the profit where you're making just enough to be happy, but you're covering your opportunity costs. You're not making any more than the next best alternative. You're making exactly the same amount as the next best alternative. Well, in a perfectly competitive market, if the firms are making profits, other firms can come into the market. And we would expect that, right? We would expect other firms to jump into the market if they can make profits that are greater than 0. And I say greater than 0, that means they're covering all of their opportunity costs. So maybe they have a job for $40,000 a year. If they jumped into this business, they might make $50,000 a year, right? That's a $10,000 profit over their opportunity cost. They jump into the market, right? They're better off. If firms are losing money, and by losing money, it's relative to the opportunity cost. So say perhaps, once again, people could get an outside job for $40,000 a year, and in the business they're only making $30,000 a year. You'd expect them to leave the industry. Well, we know, though, that when firms leave the industry, the price goes up. If they enter the industry, the price goes down. So the profits in a perfectly competitive industry move to 0, right? Price is going to be equaling the average total cost, marginal revenue, short-run marginal cost. All of these will be equal to each other. And a really key point, and I think you should star this in your notes, in the long run, the equilibrium we expect in the long run, a competitive firm will earn 0 profits. It's a huge point that because of this idea of free market entry and exit, and if profits seem to be in a particular market, firms will jump into the market. If firms are losing money, some firms will leave. That will push, there's a lot of pressure then pushing the equilibrium profit level for firms in perfect competition down to 0. So it's an interesting point. Perfect competition, it's got these very interesting features. Once again, it's a bit of an extreme case. There aren't many industries that emulate this, but there's a lot that are close. So that's why we go through this. The next section, we're going to talk about the other extreme, which is monopoly.